By the end of this course, students would be able to gain knowledge of different classifications of chart patterns, such as reversal patterns, continuation patterns, and neutral patterns. Learn practical steps to trade each pattern effectively, including identifying entry points and proper placing of stop losses. And develop a skill to identify a realistic profit targets based on pattern measurements and market context. The first technical analysts in the West emerged during a time deeply influenced by the naturalist movement, with figures like Charles Darwin studying and observing natural phenomena. Inspired by these principles, early analysts extended the idea of drawing lines on charts to determine market direction and began identifying patterns. These patterns help traders anticipate potential future movements, in line with the principle that history repeats itself. As mentioned, the first technical analysts in the West were technicians. Classical pattern analysis involved projecting observations from their daily lives onto price charts. The primary concern for these analysts was whether prices would continue moving in the current trend or reverse direction. Consequently, patterns are broadly classified into two groups: reversal patterns, which indicate a potential change in trend, and continuation patterns, which suggest the trend will likely persist. A common structure that occurs in financial markets is the double top and double bottom pattern. These patterns form when prices reach a high or low, pull back, and then retest that level without breaking through the previous extreme. When this pattern occurs, traders often view the pullback point between the two extremes as the trigger area for a trade. To establish a target, the vertical distance between the price extreme and the pullback point is measured and then projected from the breakout level. One of the most reliable and widely recognized reversal patterns is the head and shoulders pattern, also abbreviated as SHS, four-shoulder head-shoulder. As the name suggests, the pattern resembles the outline of a person's upper body, with a left shoulder, or a high, a head, which is an even higher high, and a right shoulder, or a lower high. Between these highs are troughs, and a line can be drawn through these troughs to represent the neckline, which acts as a key level for confirming the pattern. A break below the neckline signals that the bullish trend is likely over and that the market may either correct itself or fully reverse. When trading the head and shoulders pattern, we draw a vertical line from the highest point of the head down to the neckline. This line is then projected downward from the breakout point to establish the target for the move. A stop-loss order can be placed just above the right shoulder to manage risk. Some traders prefer to wait for the price to pull back to just below the neckline after the breakout before entering a trade, as this pullback can offer a more favorable entry point. The inverse of the head and shoulders pattern, known as the inverse head and shoulders, works in a similar manner. In this case, we have a low and a downtrend followed by an even lower low, and then a higher low, indicating that the latest swing down could not reach the depth of the previous drop. As with the standard pattern, we establish a neckline by connecting the highs of the upward bounces. Traders should wait for the price to break through the neckline before assuming that the market has turned bullish. To determine the pattern's price target, we measure the distance between the lowest low and the neckline and project this distance upward from the breakout point. Note that necklines aligned with the direction of the trend often result in more explosive breakouts compared to those drawn counter to the prevailing trend. This is because breakouts in the direction of the trend are generally supported by existing market momentum, leading to stronger and more sustained price movements. When a particular resistance or support level becomes stronger as it is repeatedly tested, triple tops or multiple tops and bottoms may form. A multiple top occurs when prices repeatedly pull back from a resistance area at a previous high. Attempts to push through this high may result in a minor break followed by a retreat, or prices may fall short of reaching the high entirely. When trading a multiple top pattern, the vertical distance between the highest point and the support level is measured. This distance is then projected downward from the breakout point to establish a projected target for the breakout. Conversely, a triple bottom may form when prices are unable to drop any lower, repeatedly bouncing off a prior low or failing to follow through when a breach does occur. As with multiple tops, when trading this pattern, the vertical distance between the lowest point and the resistance line is measured. This distance is then projected upward from the breakout point to establish a target for the breakout. Diamond patterns are distinct consolidation formations that occur at market tops or bottoms. They are characterized by a broadening range in the initial phase, followed by a contracting range as the right side of the pattern develops, forming a diamond or rhombus shape. While diamond patterns are typically viewed as reversal patterns, they can also be considered neutral until a breakout occurs. When trading diamond patterns, the target for the breakout can be determined by measuring the height of the diamond and projecting this distance from the breakout point. A stop loss should be placed at the opposing support or resistance line, depending on the direction of the breakout, to manage risk effectively. Rounding top and rounding bottom, also known as saucer and inverted saucer patterns. Rounding patterns are uncommon but are considered highly reliable indicators of a gradual shift in market sentiment. These patterns can easily be mistaken for a typical consolidation and generally take longer to form than other patterns. A rounding top is a bearish reversal pattern signaling a gradual shift in sentiment from bullish to bearish. It forms a dome-like shape where rising prices plateau and begin to fall gradually. When trading a rounding top, measure the distance between the highest point and the support level, then project this distance downward from the breakout point to determine the target. A stop loss should be placed above the latest swing high. A rounding bottom is a bullish reversal pattern appearing as a saucer-like formation. It begins with gradually declining prices, flattens out, and then starts to rise. When trading a rounding bottom, measure the distance between the resistance level and the lowest point of the saucer, then project this distance upward from the breakout point to establish the target. A stop loss should be placed below the latest swing low. Flags and pennants are considered continuation patterns, indicating temporary pauses in a market rally or sell-off, with the expectation that the price will eventually break out in the direction of the prevailing trend. Flags are characterized by a steep price movement, known as the pole, followed by a brief period of consolidation. This consolidation is defined by parallel or nearly parallel support and resistance lines, creating a rectangle-like shape. Flags are expected to break out in the same direction as the preceding trend. Bullish flag is identified by a strong upward movement forming the pole, followed by a consolidation. The breakout typically continues upward. To establish a price target, measure the height of the pole and project this distance upward from the breakout point. Inverted flags work similarly but are identified by a sharp downward movement, followed by a consolidation with parallel support and resistance lines. The price is expected to break lower, and the target is calculated by projecting the height of the pole downward from the breakout point. Pennants are similar to flags, with one key difference: the shape of the consolidation. Instead of parallel lines, the support and resistance lines of a pennant converge, forming a triangular shape as the range tightens. Bullish pennant is characterized by a steep rise in price followed by a triangular consolidation. The breakout is expected to continue upward. To establish the price target, measure the length of the pole and project it upward from the breakout point. The bearish version starts with a sharp price drop, followed by a triangular consolidation. The breakout typically continues lower, and the price target is established by projecting the length of the pole downward from the breakout point. Any practitioner of technical analysis knows that markets inevitably spend a significant portion of their time in consolidation. During these periods, prices may move within well-defined support and resistance levels, forming patterns that do not necessarily provide a clear indication of market direction. Such formations are referred to as neutral patterns. Neutral patterns are important because they alert traders to developing market conditions and help identify potential entry points for a trade. However, they are not inherently predictive of future price direction and should be analyzed in conjunction with other tools and market context. A symmetric triangle forms when there is a series of lower highs and higher lows, allowing us to draw converging trend lines that bound the price action between a bearish trend line and a bullish trend line. This formation is considered a neutral pattern, as it does not indicate a clear directional bias until a breakout occurs. Symmetric triangles reflect market indecision, where buyers and sellers are in a state of flux. As a result, the highs and lows draw closer together, with neither side gaining a decisive advantage. To trade the breakout of a symmetric triangle, measure the distance of its widest point or the vertical height of the triangle, and project this distance in the direction of the breakout to establish a price target. The opposite trend line serves as a logical point for placing a stop loss to manage risk effectively. An ascending triangle forms when there is a series of higher lows converging with a flat resistance line. This pattern indicates a steady increase in bullish momentum, suggesting that buyers are gradually overpowering sellers. The expectation is that the bears will eventually fail to hold the resistance level, leading to a bullish breakout. Ascending triangles can act as either reversal or continuation patterns, depending on the preceding trend. However, they are generally considered to have a higher probability of a bullish breakout. To trade this pattern, measure the widest vertical distance of the triangle and project this distance upward from the breakout point to establish a price target. A descending triangle forms when there is a series of lower highs, converging with a flat support line. This pattern indicates increasing bearish momentum, as sellers push prices lower with each rally, while buyers consistently defend a specific support level. The expectation is that the support level will eventually fail, leading to a bearish breakout. Descending triangles can act as either reversal or continuation patterns, depending on the preceding trend. However, they are generally associated with a higher probability of a bearish breakout. Wedges are chart patterns formed when support and resistance lines are both sloping in the same direction, with the distance between them gradually narrowing as the pattern develops. These patterns are considered neutral because they can lead to either a continuation or a reversal of the prevailing trend, depending on the breakout direction. A rising wedge is characterized by a series of higher highs and higher lows, with the support line having a steeper upward slope than the resistance line, causing the lines to converge. In an uptrend, a rising wedge is typically seen as a bearish reversal pattern, indicating the downtrend may occur after the wedge completes. In a downtrend, it is considered a bearish continuation pattern, suggesting a potential continuation downward rally. When trading this pattern, traders wait for the support line to break. The target price is calculated by measuring the vertical distance of the wedge at its widest point and projecting this distance downward from the breakout point. A falling wedge is defined by declining highs and lows, with the resistance line showing a steeper rate of decline than the support line, leading to convergence. In an uptrend, a falling wedge is often viewed as a bullish continuation pattern, signaling that the uptrend may resume. In a downtrend, it acts as a bullish reversal pattern, suggesting a potential upward breakout. To trade a falling wedge, traders wait for the resistance line to break. The target price is determined by measuring the vertical distance of the wedge at its widest point and projecting this distance upward from the breakout point. Similar to other neutral patterns, the cup and handle can signal either a reversal or a continuation of the prevailing trend, depending on where the pattern forms. This pattern is characterized by a U-shaped price action, where prices initially decline, then recover to their original level. Following this recovery, a period of consolidation forms the handle, which eventually leads to a bullish breakout. When trading a cup and handle pattern, the depth of the U-shaped section plays a key role in gauging the strength of the breakout. A shallow cup often signals stronger underlying demand and is more likely to result in significant price gains. To calculate a price target for the breakout, measure the vertical distance between the pattern's right peak, the resistance level, and the lowest point of the trough. This distance is then projected upward from the breakout point. Note that the inverse of a cup and handle pattern also applies in technical analysis, suggesting a bearish bias for the market. This formation, often referred to as an inverted cup and handle, is characterized by an upside-down U shape followed by a consolidation phase forming the handle. A breakdown from this pattern typically signals further downside potential.
Thank you for watching. To reinforce your understanding of this video, make sure to take the accompanying quiz pinned in the comments section below. And remember to like, comment, and subscribe for more trading content. Comment yes to get your free trading ebook.